What is up, money makers? Sanjeev here. Anyway, so this is a follow-up video on the video I made yesterday, which talks about asset classes and how do you diversify a portfolio. But I want to create a clarity, or rather give you an understanding of where or how this money is invested when you invest in these different asset classes. All right, so if you remember, I covered about bond funds, I covered about equity funds, and I covered about REITs. There was one asset class that I did not mention, which is money market. Right, so today I will basically cover these four areas and also break it down to you on how the money is invested and what sort of returns you can generally expect. Okay, so it goes from the lowest risk to the highest risk. When you talk about the lowest risk asset class, you have money market. Now, money market is money that is technically not invested. It is just used for financial institutions' liquidity. Meaning to say, if you've heard of something called an overnight policy rate or OPR, that is how much a bank needs to have in the form of liquidity, any financial institution. So Bank Negara states that recently they slashed it down from 3.25 to 3%. What this indicates is a bank or financial institution needs to have a minimum of 3%, 3% of their entire net worth in the form of cash. So this is where money market funds come in, which is used to equalize or used to just transfer among these financial institutions to balance out their net worth at the end of every single day, which is why it's called overnight policy rate. Now, when you invest money in a money market fund, there is no risk at all. There's very minimal risk, but then you also have a growth rate of anywhere between 1.5 to 2%. That is generally it. That is the only interest rate you will get over a year, right? So as you can see, it's not really the best investment for medium to long term. But the reason why people have the money there is a temporary parking spot if you want to move it from one asset class to another asset class. That is money market, the lowest risk. Now, moving on, we have bond market or bond funds. Bond funds is basically funds that are used to lend out. Okay, and who do they lend it out to? They basically lend it out to companies and government. All right, so we have government bonds and we have corporate bonds. And as you may know or understand, government bonds tend to give a slightly lower return, corporate bonds tend to give a higher return, right? And the risk element in a bond fund is said to be low, but there is an element of risk in a bond fund. All right. Now, what are the risks there? Basically, you have defaulters, you have primarily defaulters actually. And so if you're familiar, bond funds will use the money out to loan, right? And based on the corporation's strength or the company's strength, their repayment will be the interest plus the principal, just like how we pay for bank loans. Now, that is bond fund. And what sort of returns you can expect from a bond fund will be generally about 3.5% all the way till 4.5%. That is the medium range size. You have bond funds that perform at 3%, you have bond funds that give all the way up till 4.5% or even higher. Right? So that is bond. The considered not very risky fund. Next one, you have REIT. REIT is real estate trust fund. Now, real estate trust fund is exactly that, real estate trust fund. So it's a fund that is used to buy and manage real estate. All right, real estate is properties, right? So in this sense, you have the fund which is being used to buy buildings, to buy hotels. It could be hospitals, it could be land, it could be really big buildings, and the fund is used to manage these buildings and get a rental return out of it, or eventually get the capital appreciation from the buildings itself, right? So most of the time you hear of the REIT funds going into development projects. You hear of them buying huge plots of lands and developing those areas, right? So that is what we have under the REIT fund. Now, in terms of risk, it's not to say that REIT funds have no risk. REIT funds also have risks, and they actually do have high levels of risk. So if you're familiar with how the property market in Malaysia is going, it may not be very exciting. So REIT funds that are invested strictly in Malaysia may not perform as well as REIT funds that are invested overseas, for example, right? So each of these funds also have, if you look through the prospectus of where they are invested, they also have the location where they're invested. They also have their distribution, meaning to say how the fund is distributed, and that could go geographically, that could go by regions, and that could also go by countries, right? So that is REIT fund. Now, finally, we have equity fund, which is considered one of the highest risk funds. Now, again, with equity and also REIT, it depends very much on where the equity is and what type of equity fund this is. You have high risk equities, which are usually the small, medium corporations. Equities, as you may know, is invested in stocks and shares. All right. So when you have an equity that is in small cap funds, which is considered the small medium corporations, these tend to have the highest level of fluctuation and also have potentially the highest level of growth. Now, you may also have equities that are in the blue chip funds, blue chip stocks, sorry, right? And these may also have a high degree of fluctuation, but it may not fluctuate as much as the small caps, right? There are also equities that are invested in different countries, for example, United States, for example, China, India, and these are subject to those risk elements in those countries, those political movements in those countries, and so on. Right. So when investing, there are all these funds and all these categories to actually really consider when you're actually looking at a portfolio or building a portfolio, right? So it may be very confusing because some companies, like for example, the company with which I am in has approximately 50 funds, right? There are some companies that have over 200 funds, right? So it may be very confusing for an investor to actually choose which fund to go in, which is why it's very important as an advisor or as someone who's building a portfolio to really understand what the client's needs are, right? Now, you may think this is all very exciting, but again, all of this has their own risk elements to it. So if you're very interested to find out how we develop portfolios and how we choose targeted assets, and also how we allocate funds based on all this all these factors, do hit me up on an email right below, and I'll be more than happy to actually help you decide on what sort of portfolio and what sort of funds you should be invested in. And as always, do look out for my other videos. I will see you in the next round. Have a nice day and peace out, everybody.